All right, so Tesla stock has been down a lot on the year, but recently as well. It's been very volatile this week. It started at 123, closed the week at just under 122, but it went down as low as 108 briefly. So a lot of people, I mean, there's competing views on Tesla, right? And the view that my view is that it is a solid company, but it's still too expensive, right? I've said before that if it goes below 100, I would be interested. But I did a little bit more research recently, and I found that basically I'd want to get it for a price to free cash flow of at most 30. And to get down there at current pricing, you're looking at probably, I think it's a little bit below $80, right? So in my mind, I wouldn't even touch it until it gets below 100, and I wouldn't be running out to buy but until it gets below 80, preferably in around 70 or so. And again, this is going to create a lot of controversy, but this is a lesson that too many people this year have learned the hard way. I think there's two examples. The first one is don't buy companies that aren't making money, right? That's the first problem. You know, how many people have gotten burned on the tattooed chefs, the Pelotons, like ARC, like these kind of ETFs and stocks that are either not making money or they trade at very high premiums, right? Tesla, I don't know if it's fair to put in that category. I don't think it is. But the difference with Tesla is that Tesla's a solid company, right? They have a good balance sheet. They're growing very nicely. Profitability, they're okay. But the problem is that they're still very expensive, right? The price to free cash flow is still 40. The PE is still 32, right? That's quite a lot cheaper than it's been over its recent history. But again, you need to compare it to the market as a whole, right? And again, whenever you compare Tesla to like Chevy or Ford, I don't know if that's necessarily a fair comparison, but the argument that people always make is, oh, there's going to be all this AI, self-driving stuff that is going to help them continue to grow. But what I think, and what the market is clearly saying, is a lot of that future growth is already priced into the stock. And this is the thing that not enough people understand, is that when a company is trading for a very high premium, right, when it has a price to free cash flow above 30, especially 40, that means that a lot of growth is already priced into the company. So when people say, oh, Tesla's, they still got all this growth that's going to happen, but it's like a lot of it, arguably all of it, is already priced into the stock, right? And another important thing that people need to understand is companies that have low earnings yields, typically the rule of thumb is if it's below the 10-year bond, those companies, especially in higher rate environments, are going to struggle, right? Those companies are going to struggle. So, and typically those are companies that trade at high premiums. So again, the point here is very simple, that you do not, just because, number one, the first point is never buy companies that aren't profitable, that aren't growing nice, that kind of stuff, right? That's the basics. But on top of that, you need to make sure that you're not overpaying, right? I mean, another example of that, Microsoft, right? I think it's a solid company, but it's expensive right now, right? There's a lot of companies, a lot of the semiconductor companies as well. I think they're solid companies, but I mean, Nvidia, good example of that, probably the best example other than Tesla, if you're asking me. Nvidia, right? Good company. It's just trading at a premium, and you don't want to overpay for companies. And again, I'll tell you exactly what I mean by this, right? If we go back, let's go 5 years, the average, the lowest that, it doesn't have a low for price to free cash flow. It's kind of annoying. the average, you want to buy companies significantly below the average, right? But the latest price to free cash flow at 40, right? I'd want to get Tesla below 30, right? And even then, it's still kind of expensive if I'm being honest, right? I mean, if you look at the low for price to operating cash flow in the last, I guess it's almost 4 years, it's gotten down to 13 and a half, and it's at 22 right now. So again, Tesla is still not cheap, right? It's still not cheap, right? I mean, let's compare it to Nvidia. Like I say, that's another good example, right? Let's compare it to Nvidia. Hopefully it loads quick here. Okay, so we pull up Nvidia here. Nvidia, the latest price to free cash flow is at 71, right? So very expensive. Price to operating cash flow 53. Again, so Nvidia is even more expensive than Tesla is right now, right? Nvidia, again, the lowest that price to free cash flow has gotten is 25, right? I'd want to get it below 40 for sure. But again, I wouldn't be running out to buy it until it got below 30, right? 30, in my opinion, is a pretty good cutoff because 30, you're still pricing in a lot of growth. 40 is you're pricing in a crazy amount of growth. Anything more than that, in my mind, it's just completely absurd, right? And this is the thing that again, new investors, any investor needs to understand that number one, you want to buy good companies. And number two, you want to buy good companies at a fair price, right? I mean, if somebody offered you to buy a Lamborghini at $10 million versus $50,000, well, $10 million is crazy expensive, but $50,000 is a screaming good deal, right? So this is the thing that people need to understand is that, again, do not overpay and make sure you're buying good companies, right? Again, Tesla and Nvidia, I think, are good examples of good companies, but they're so expensive, right? And again, a lot of people don't realize because in a low rate, again, I brought this up, but this is very important because in a low rate environment, you can get away with, not always, but it's easier to get away with buying companies that trade at very high multiples because they can borrow money easily. And not only that, it's less attractive to invest money in bonds, right? So when they can borrow money easier, it's easier for them to grow. And number two, when bond yields are lower, that just creates more of an incentive for investors to put money into stocks, right? So again, how these companies go, it's going to depend a lot on rates, right? It's going to depend a lot on rates. If we get a big recession and the Fed cuts rates down, way down again, then I think you could see companies like this break out. But I think that the era of very easy money, of these high multiple growth stocks being the best place to have your money, it's gone. And it probably never happens again anytime soon, right? I think that rates are going to go down over the next year, but I don't think we get back down to 0.25 like they were. And I don't think that we get these massive stimulus bills that also help this stuff, right? Now, to be fair, I think that we probably get a more, over the next decade or so, more of a focus on producing stuff locally, inside the States, but that will only have so much of a benefit, right? And not only that, a lot of that's going to get priced in ahead of time, which some of it may already have been priced in, right? So again, I just wanted to talk about this because, again, to sum it up, this is going to continue to burn people, right? And here's the thing: if we get arguably there already is a recession, right? But let's just say that we do get a recession and the Fed doesn't cut rates as soon as we think they do, or they continue raising. Companies that trade at these high multiples, they're the ones that are going to get hit the most, right? And like I say, people have learned that the hard way. So again, over the long run, I think that these companies will be okay, but we're not going to see the massive growth that we have seen over the last decade out of these companies. Companies like Tesla, Nvidia, we're not going to see it. It's very unlikely because rates aren't going to be at rock bottom levels like they have been for most of the last decade. And on top of that, bond yields are higher, and on top of that, I think that people's risk tolerance, or at least perceived risk tolerance, is going to change, right? And it already has changed. And I think that there's just, personally, I think that there's just better opportunities elsewhere, right? I think that it is a no-brainer that some of these a lot of these commodity companies are going to do well over the next decade or so. I mean, there is a very clear shortage in oil and gas in a lot of these natural minerals and stuff. And on top of that, I think that there has been underinvestment in a lot of these companies that produce the things that we really, really need, right? The boring kinds of companies. I think that those are the ones that are going to be they have been the ones that have done the best over the last year or two, but I think that they're going to be the ones that do the best over the next decade. Not that you won't have some diamonds in the rough tech stocks. I'm not saying that, because there is some tech stocks I like. But I think that, again, there is going to be this rotation, right? The same kinds of stocks do not do good over and over and over again, right? There is rotation. So anyway, again, to leave it there, everything here, just my opinion. Obviously, do your own due diligence, all that kind of stuff. But I just wanted to make a video about this because I think it's going to be a sign of things to come, right? It's going to be a sign of things to come. So anyway, if you like the video, hit that like and subscribe, and stay tuned for more.